Okay folks, I have 20 minutes to pack in a little bit of a historical journey. I'm going to talk about liquidity, fragmentation, and the impact of transparency. And to do that in a kind of effective way, I'm just going to show you some basics, which I think many of you will have seen before, in order to sort of like explain the story and how our markets, our FX markets, our equity markets, and indeed our crypto markets got to the state that they're in today. So I'm going to be asking a few questions. The first question is, has technology made capital markets more efficient today? Is transparency, it may seem logical, but is transparency actually beneficial to markets? If we've got these great big exchanges all the way around the world, the Deutsche Börse, the London Stock Exchange, why is it that OTC liquidity, so liquidity that's not on exchange, is so critical today? And then another question that some of you may have never thought about, but hedging. Why is it that hedging, the activity of hedging, is so relevant to pricing? So hopefully I can answer some of these questions as I talk. Digitization has had a massive impact on markets. If you go back, in fact 50 years, 1970s, there was no such thing as computer trading. You can see on the left-hand side of this screen, this is what it looks to look like in a trading pit. Orders were called in to market makers. Those market makers were making prices with their hands to gesture buying and selling. That evolved into the banks, the big banks, Goldman Sachs, JP Morgan, Morgan Stanley. They became the market makers, and they had traders with 50 trading screens managing the risk. And today, in today's markets, Exness trades $4 trillion per month. We're the largest retail market maker in the world, and we have 0 traders in our company. No one has the title trader, because today 100% of the business is automated. We have people do monitoring roles. So that's the state of play today. So let me just recap. What do I mean by transparency? Most of you, at least your clients, will have seen this before. It's called the order book. And this is what transparency is. The order book shows, on the one hand, it shows the offers. These are the prices you can buy from the market. On the other hand, these are the prices that you can sell to the market. You see quantity. Okay, I'm using Bitcoin as an example here. I know we're a Forex Expo, but this is an asset that's on everyone's mind. So I'm using Bitcoin to show you here, but this is volumes. So these are the volumes of Bitcoin or foreign exchange or equities that you can purchase. This is what the order book looks like. So in this example here, you can buy 1.19 Bitcoins for the price of 28,367. Okay? And this is what's referred to as the top of book. This is the best bid and the best offer, often referred to as the touch price. So the reason I'm showing you this is I want to familiarize everyone with what we talk about when we say transparency and fragmentation. So this is the modern markets. This is what traders see. This is what brokers see today. Now, we're led to believe that because all these prices and all these volumes are together, then all participants can trade fairly. That's what we're led to believe. The reality is that you can see those prices, but it doesn't necessarily mean you can execute on them. We're led to believe that these prices are state-of-the-art snapshot of real-time buying and selling in the markets. The reality is, and I'll show you, that these are prices that come from a few exceptionally big market makers, just a few. They don't represent the general buying and selling interests of standard clients. That the best bid and offer is the best possible price. As you'll see in the example, that does not mean best execution, and I'll explain that in the 15 minutes I have left. We're also led to believe that centralized exchanges are the largest pools of liquidity. That's where all of us get our prices from. That's how all of us execute. Again, it's not reality. Most of the important big liquidity is off exchange. Okay, and finally, we're led to believe that when we see these prices, that these are the best possible prices that are out there. Again, that's also not true. And the reason for that is those that are producing the prices they have to add a buffer on those prices because they're concerned about toxicity. They want to have a layer around their prices so they don't get run over by toxic clients. So these are some of the myth busters. So when you look at this order book, you might think about Joe selling to Jane, but it's not. In reality, it's made up of very big, notable market makers. So a good example is Citadel. Citadel here is on the bid and on the offer. Citadel is facilitating buying. XTX, Tower Research, Jump Trading, many of these firms you may not have heard of, but these dozen or so companies, they control the global liquidity across the world that all of us use to execute our business today. So the question is, how did equity markets get like this? And this is a very quick whistle-stop tour. So in the past, again, early 2000s, equities buying and selling of shares were dominated by regional exchanges. If you were in America, you were buying shares from the NYSE. If you were in London, you were buying UK stocks from the London Stock Exchange. If you're in Germany, you're doing it from the Deutsche Börse. They had a very sticky position and their prices were very high and the banks got pissed off. And so in about 2007, the disruptors entered the market. 3 major disruptors in the UK entered. One called Turquoise, which was 12 investment banks all getting together saying we're going to create our own exchange. One was Chi-X, a new private equity-backed exchange, and then an American entrant from Kansas called BATS. And what did that mean? It meant all of a sudden that British Telecom shares were now trading on 4 venues. So if you wanted to buy British Telecom, where do you buy it from? Chi-X, Turquoise, or London Stock Exchange. It suddenly creates a problem. And so what the big banks did, and this is a term some of you may be familiar with, is they were forced to create what's called smart order routers. Okay, these are highly technical products that banks had to build in order that they could go and get shares from 4 venues at the same time. Because if you look at the screen here, if I've got 20,000 shares of BT on Turquoise and I've got 30,000 shares of BT on Chi-X, and my client wants to buy 50,000 shares, I need to go to 2 venues. This was the start of the electronic revolution, the digital revolution in equities. So you suddenly had this emergence of smart order routing technologies. Goldman Sachs had one, UBS had one, and the reason this is important is it changed the transparent markets. It made the order sizes on exchange really small. It made it difficult for people to buy and sell shares without having market impact. And then you've got the rise of what's called the dark pools. Some of you may have read some of the books, but dark pools were off-exchange liquidity owned by the banks. I use Goldman as an example because it's my former employer and I know about it, but Sigma X was the name of the off-exchange liquidity at Goldman. And so let's just imagine a real-life scenario now. A client comes along and wants to buy 10,000 shares of BT Group. You can see here that every single exchange is showing a bid and offer and a quantity of BT Group. So what happens? Well, Goldman Sachs Smart Order Router, it goes to London Stock Exchange, it gets the first 200 shares at a price of 117.25. It then picks up another 1,000 shares at 117.26. And finally, it picks up 8,800 shares at a price of 117.28. So the client has now purchased this. By the way, I've translated this from pence to pounds for those of you that are observant. The point is that Goldman Sachs now has used a piece of technology to go out into multiple venues to try and purchase the BT shares. But there's a better price on Chi-X. So for that same BT shares, the broker can go to Chi-X, can get 10 shares at a price of 117, can pick up 9,990 shares at a price of 117.26, and gets a better execution price. And now to my final point around off-exchange liquidity and the belief that markets are the most transparent. In this case here, Goldman Sachs has its own liquidity. It's got 9,600 shares inside Goldman Sachs that no one else can see. So now what does it do? Goldman Smart Order Router, it takes 9,600 shares from Goldman. It goes to the top of the book, the best price at London Stock Exchange. And then it goes to the best price on Turquoise. And sure enough, the best execution price in the market wasn't the first scenario of one venue. It wasn't the second of the secondary venue. It was actually when a piece of technology went to 3 different locations, on order book and off order book, in order for the client to get the best execution. That may seem irrelevant, but when you think about companies that are buying and selling billions of shares, if you don't use that kind of technology, then you're going to waste a heck of a lot of money. I mean, literally millions. So that's the equity market structure. That's how we got to where we are. Now let's look at FX. So the FX market structure today, like equities, is disaggregated. It is all over the place. So you have some FX liquidity with the very big banks that are market making. You have a lot of FX liquidity with private companies. You have some on exchange with, like the London Stock Exchange, ICE, LMAX, etc. The point is that FX liquidity is all over the place today. So what does the FX market do? The FX market doesn't have smart order routers. It has what's called aggregators. And what aggregators do is they go out, they look at the best price across all markets, and then they display for the client, this is the best price. So let me give you an example. I want to buy 20 million euro dollar. So typically, I would go to the liquidity provider that's providing the best price. So this liquidity provider is happy, they won my order, they got the order, they've got paid the spread. They earn a little bit of commission. But that liquidity provider immediately, and you wouldn't know this, that liquidity provider immediately doesn't want the risk on their book. They automatically hedge it away. Maybe they're hedging away $1 million every time. So you've given them 20 million, they've earned a spread, you've saved 2 pips, but every time they automatically hedge that trade back into the market because they don't want it, you're losing 2 pips on every trade. So best price gained you 2 pips on 1 million, and then it lost you 2 pips on 19 million. My point is that even in FX, when you see highly transparent pricing, you can never be sure whether or not it's best execution, because it very much depends on the intent of the party that you're executing with. And so finally, and I have 7 minutes, onto crypto markets. And crypto markets, as you know, are the newest form of markets. They're very heavily based around centralized exchanges. The notion of smart order routing, the notion of aggregation, all of these are new concepts in crypto, and they're new technologies that are going to be evolving over the coming period of time. But there is a very dominant liquidity source today for crypto, and that is Binance. It's well publicized, everybody knows it's much bigger than anybody else. But let's look at the problems with liquidity. So here's a real market example. Many of you will have heard that BlackRock, the largest asset manager in the world, managing assets for millions of people, has close to $10 trillion of assets under management. BlackRock announced that it's going to do a spot Bitcoin ETF. The effect of that news was a move of 10% in Bitcoin. And this is my Bloomberg showing you that move. Similarly, when you try to execute reasonably large orders on the market, it may not affect our retail clients, but this is impacting our retail clients. But when an institutional client tries to execute reasonably large amounts of Bitcoin on exchange, you can see here, this is an exchange, it's Kraken in fact, and this is what happens every time a 200 Bitcoin purchase is made. It moves the stock, it moves the crypto 10%. So imagine a situation now where BlackRock has told the world that it's interested in investing into a Bitcoin ETF. Now, given the size of BlackRock, if BlackRock was to take just 0.01% of its assets, so absolutely tiny, to cover an ETF, they would need to trade 188,462 Bitcoins. And you can imagine the impact that that kind of purchase would have on the market. It would be 940 of those 10% moving trades to execute this Bitcoin ETF. So who knows whether or not BlackRock is going to be successful or Fidelity. The point is that the crypto markets are going to have to adopt some of the technologies and the frameworks that we see in equities and FX in order to become more widespread and adopted. So I've taken you here through a whistle-stop tour of market structure evolution over the last 10 to 15 years. I hope you found it reasonably informative. I've done my best to keep it within the time frames. At the very start, I posed 4 questions. And having given you now a quick explanation of of my presentation, these are the answers. So the first question is, has technology made capital markets more efficient today? Well, on the one hand, technology allowed the disruption to occur. You saw that. Without a smart order router, you could not have a situation where markets could effectively evolve. And it has had the effect of reducing the cost of trading and increasing the volumes in the market. But on the other hand, what it's really done is created a technology arms race, which means that those with the deepest pockets and the most money are the ones that are most successful in trading in capital markets today. The second question was around, is transparency beneficial for markets? I don't think anybody could argue that transparency is not good. In fact, it's a human quality that we like in other people. We like honesty, we like transparency. So when you talk about transparency in markets, it's natural to assume it's good. But as I've demonstrated to you, in equity markets, transparency doesn't necessarily mean best price, because a lot of liquidity is off exchange. In FX markets, best price doesn't necessarily mean best execution. It depends on whether or not the counterparty is hedging. If we've got exchanges, why is the OTC liquidity so important? Well, the reason it's important is that when you are executing fairly large business, and again, our retail clients don't do this, but the institutions do that, and it moves markets, and it has an impact on retail trading. The reason OTC liquidity is so important is it enables institutional clients to trade privately without market impact, which means you don't get big shocks in volatility in the markets. And then finally, why is hedging so relevant to pricing? Well, in fact, many companies, if you don't have a big, strong balance sheet, you might be happy to make a price to a customer, but you may be concerned about holding that risk on your balance sheet, and so you hedge it away. By hedging away your business, in fact, what you're doing is you're having market impact and potentially producing a negative price. I thank you all for listening. I know it's tiring in the afternoon. I may be whining and talking about too much technology stuff. I'm passionate about markets. I hope you all have a fantastic time here. And if anybody has any questions, I can be accessed at the back. Thank you.
Uncanny ability to simplify complex concepts and make everything accessible to everyone. Allow me the distinct honor of introducing Mr. Mahmoud Al-Qudsi, the Senior Market Strategist at ADSS. He is a professional market strategist with nearly 15 years of experience in the financial market, a renowned specialist here to analyze reversal patterns in technical analysis. Join me in welcoming him on stage, everyone, with a big round of applause.
Hello everyone and welcome. My name is Mahmoud Al-Qudsi and I'm Senior Market Strategist at ADSS. Well, today we're going to talk about reversal patterns in technical analysis. How could we spot them on the chart? And how could we employ them in our trading process? So without any further ado, let's get started with the risk disclaimer. I'm sorry, how could we just use this? Green? Okay, so in terms of the risk disclaimer, the content of this presentation is purely educational and doesn't constitute at all any trading advice. So, the first question that comes to my mind when I want to trade the market, how can I define my entry and exit points. So let's think about it. I don't want to trade haphazardly. I don't want to choose my entry and exit point at random. I want to be organized and I want to find out the way that I can potentially make profit. So the answer of this question is by applying technical analysis principles. So what is technical analysis? Technical analysis studies the market in terms of the price action, i.e., it says that the history repeats itself, i.e., some of the traders, or let's just say the biggest majority of traders, they tend to behave in a specific way, sometimes and all the times, sometimes in specific situations, risk on, risk off, etc. So these signals that we get from the market are telling us who is the dominating part in the market, bulls or bears. And by knowing who is the dominating part, I have to join this part. In that case, if I just monitor these parts and I follow them, I can make a very successful trade. So, reversal patterns, they used to show in any market, whether it was FX, commodities, etc. And at the same time, there are two categories. We have the reversal and we have the continuation. So what is the reversal? The reversal is telling me we have a trend, and when I see this shape or this pattern in the market, is telling me that there's a big possibility that the market will reverse. So if I have an uptrend, this uptrend, it might reverse to become a downtrend and vice versa. Makes sense, right? On the other hand, the continuation pattern is kind of a timeout from the market. It's saying to me, let's take a pause until see what's going on in the market. So if I have an uptrend and I see this shape, the most probable that the uptrend is gonna continue. But there is very important detail about these patterns. I have to have a clear, and I have to underline the word clear, pattern before the clear trend before this pattern. So I have to have an uptrend, or I have a downtrend, because a sideways trend before these patterns doesn't serve me. I can't apply these patterns if I have a sideways trend. All right? So, what are these trends? The trends, we have the uptrend, which is a series of highs with higher highs and lows with higher lows, i.e. the bulls were in charge to push the price upward. And we have also the downtrend. The downtrend is a series of highs with lows, lower highs and lower lows. So in that case, the bears were in charge and were successful to push the price lower. But we have the sideways move, i.e. a trendless move. We have a series of lower highs with higher lows. In that case, the market is moving horizontally and there is no part in charge, nor the bears or the bulls. So, as this introduction, we can see who are our guests today, if you will. Head and shoulders, inverse head and shoulders, the double top, the double bottom, the triple top, and the triple bottom. And I will try to make it as simpler as I can, because believe me guys, it's very simple and it's very straightforward and is very helpful in the trading process. So let's get started with the head and shoulders. So first of all, I need to look at the chart. I have to have an uptrend, because this pattern is a bearish pattern. So if I have an uptrend, I have to try to spot the left shoulder, the head, and the right shoulder. And then I have to draw the neckline. What is the importance of the neckline? The neckline helps me a lot in defining my exit and my entry points. We remember at the start of this presentation, how can I define my entry and exit points? So through these patterns, I can measure the distance from the head to the neckline and apply the same distance to the downside, So I can short the market below the neckline. Again, my exit point is at the target of this pattern. And where is my entry point? Is below the neckline. So as I said, my potential entry points are below the neckline, so I'm good to short the market below the neckline, and my exit point is at the target of the pattern. So let's take an example on the chart. So here we see the uptrend, as we see highs with higher highs and lows with higher lows. Alright, so this is the first condition I would tick it. Then I spot the left shoulder, the head and the right shoulder, and then I can draw the neckline. So where is my entry and exit point in this trade? I have to measure distance from the head to the neckline, apply the same distance to the downside, and my entry points are obviously below the neckline. Alright? So, as I said, and sometimes the market might give me more than one opportunity to trade or to process this trade. The first one is right away after the break below the neckline, and the second one, as we see here, the market rallied, tested the neckline again, and then failed, and then continued to trade lower. So we need to be very careful and kind of as snipers in order just to spot these opportunities and trade them. So, and as we see here, we had an uptrend, and what was an uptrend became a downtrend. Why? Because this is a bearish reversal pattern. So, let's move to the following pattern, which is the inverse head and shoulders. The inverse head and shoulders is a bullish pattern. So, what is the distinguish between the bearish and bullish? The bullish is going to the upside, and bearish is going to the upside, to the downside. So I have to see where the start is from. The start here is a downside. In our previous example, the start was an uptrend. So here we have a downtrend. We spot the left shoulder, we spot the head, and we spot the right shoulder, and then we have drawn the neckline. Then we measure distance from the head to the neckline and apply the distance to the upside, and here I have my possible entry points. So it's very simple, very straightforward. I have to see the trend, the downtrend, spot the shape or the formation of the head and shoulders, whether it was an inverted or a normal, and then be careful and draw the neckline properly, and then I can go long, i.e. I can buy above the neckline if the pattern is bullish, and I can short the market if the pattern is bearish. So here my possible entry points are above the neckline, and also my exit point is at the target of this pattern. And let's see an example on the chart. Here we see a downtrend, which is a series of lows with higher lows and highs with lower highs. Okay, first condition ticked. Then I can see the left shoulder, the head, and the right shoulder. So the formation is also ticked. I draw the neckline and then measure distance from the head to the neckline and apply it to the upside, so I can find my target or my exit point, and obviously I can buy above the neckline. So it is very important to wait until the break happens. I have to buy either above the neckline or below the neckline. If we have a bullish pattern, I have to buy above the neckline, and if it's a bearish pattern, I have to short below the neckline. And as we see here, the market reversed because it is a reversal pattern anyway. Our following pattern is a double top. The double top also is a bearish pattern. We have an uptrend, we have the first top, and then the second top. And what we say is the exact same. You know the drill. We draw the neckline, and then we measure distance from the first top to the neckline and apply it from the breaking point. So if I apply it from the breaking point, I've got my exit point, and obviously my entry points are always below the neckline. Okay? So it's very straightforward, and it makes sense all the way. So here, as we see here, we have a high with higher highs and lows with higher lows. So we have the uptrend, we spot the first top, we spot the second top, and then we do the neckline. So the rest is yours. As we see here, we can short the market after the break below the neckline as we measure a distance from the first top to the neckline, apply it to the downside. We have our exit points and our entry point always in the bearish pattern below the neckline. And as we see, the market rewarded me another opportunity to trade this pattern, as after it hit its target, it went, retested the neckline, tested it, and then failed to break above it and to continue above it. Then I had another trading opportunity, and the trend, which was uptrend, it became a downtrend. Very simple, very easy. The double bottom pattern, it's a bullish pattern. We have a downtrend, we spot the first bottom, we spot the second bottom, and then we draw the neckline. And as you see, my entry point is going to be above the neckline, my possible entry point, and my exit point is at the target of this pattern. Alright? So it's like, you know, whenever you check the chart and you see something as simple and as clear as that, okay? But bear with me, guys, because these patterns, as long as they are very simple and straightforward, but they are infallible, no, I wouldn't say they are infallible. Always I have to have in mind that the chart or the market might reverse on me, so I have always to trade with a risk management strategy. However, this is a plan. Yes, it is a plan. If I accumulate more signal with it, it is a very good plan, and also I don't have to omit the risk management strategy that I'm using. So let's go to the example here with us on the chart, on the gold chart. Here we go. We have a downtrend, and then we spot the first bottom, we spot the second bottom, we drew the neckline. Okay, we measure the distance from the first bottom to the neckline and apply it to the upside. Our entry point here in this bullish pattern is above the neckline, and my exit point is obviously at the target of this pattern. Okay? So, follow me. And as we see here, the market has reversed because we insist it is a reversal pattern. A triple top pattern, you know the drill. We have an uptrend, we spot the first top, the second top, the third top, and then we draw the neckline. We measure distance from second top to the neckline, apply it to the downside, and my possible entry points are below the neckline, and my exit point is obviously, as you see, by the target of this pattern. And let's take another example on the silver this time. We see here an uptrend, then we spot the first top, second top, the third top, and then we draw the neckline, measure a distance from the second top to the down to the neckline, apply it to the downside, and then here we go. We've got a very successful trade. Okay, so my entry point below the neckline, and then my exit point is at the target of this pattern. And last but not least, the last pattern with me today is the triple bottom pattern. We have a downtrend. I spot the first bottom, the second bottom, the third bottom, and then drawing the neckline, measure distance from the second bottom to the neckline, apply to the upside. So I've got my entry point above the neckline, I'm good to go to buy above the neckline, and my target or my exit point is where we see after the measure the distance. And then let's take an example on that. On the Kiwi Japanese yen, we have a downtrend. We see the first bottom, second bottom, the third bottom. We draw the neckline, measure distance, apply to the upside, and as you see here, what was a downside trend became an uptrend. So that's it for me today, and I'm happy to take your question.
Well, I know that they're nice and worth talking about, but actually, this is why I'm here today. I am here today to tell you about something. It's the first time you're gonna ever hear about it, and I'm sure the majority of you didn't even expect that it will ever exist. In Easy Markets, we have a tool. Please focus with me, guys. In Easy Markets, we have a tool in which you can cancel your losing trades and keep your profitable trades. So, let me repeat, Easy Markets is the first and could be the only broker on the face of earth that gives you the chance to keep your profitable trades and get rid of, cancel, remove, delete, whatever you want to call it, your losing trades. So, is this a dream? Of course it's a dream. How does it work actually? Let's see how this works. Okay, simply, here, as you can see, we chose for you oil. Let's say someone chose to trade 25 barrels of oil. So, after that, he will see that it's written here, risk $4. We have 136 hours. So, if you choose that you want to, let's say, insure your trade for 1 hour, you're gonna be, let's say, paying $4, as you can see on the right-hand side on the top. It's called deal cancellation fee for US dollars for 1 hour. So, which means if I just spend $4 more, extra $4 more, I will have a trade which will go for a whole hour. Whatever trade from this trade, whatever profit I make, it's going to be $1, 10, 100, 1,000, 10,000, $1 million profit. It's yours. In case, unfortunately, this trade goes sideways and you start to lose, I don't mind, and it doesn't matter how much ever money this trade is losing. If it's losing 1,000, 10,000, 100,000, as long as you close this trade within the hour that you chose there, all of the amount that you were losing will automatically go back to your trading account as if this trade never existed from the beginning. And all that you spent was $4. So in other ways, let me make this more simple for you. It's exactly or very similar to when you pay insurance for your car. Let's say you come at the beginning of the year and you want to pay insurance for your car. So let's say you pay $300 insurance for your car. And then, so your car for a whole year would be insured. If nothing happens, you don't make any accidents, well, thanks God, that's very good, so everything is going good. But if you make an accident, in that case, the insurance company will come and cover all of your costs. This is exactly the situation within the deal cancellation. You pay this very small fee that it was, let's say, around $4 here in this example, and you have your trade insured for a whole hour, or you can choose actually 3 or even 6 hours. And if you make profit, then everybody's happy. And if you lose in that case, and you close the trade within the period, it's very important, guys, that you have to close the trade within the period that you chose. If you close the trade within that period, all of the money that you lost will go back to your account immediately as if nothing happened. So, actually, is this a dream? Of course it's a dream. It's my dream, and I'm sure it's your dream. I'm sure it's the dream of every single person or trader on the face of earth. Who is here to lose his money? Any of you here to lose money? I bet not. This is the only way that you can ensure that you're not going to lose your money. Actually, if someone wants to lose his money, I can give him my bank account. So, this is a dream. It's not only my dream, not only your dreams, it's everybody's dream. And it's a dream that easy markets and only easy markets made come true. So, all of our traders are champions. All that you have to do, open an account with easy markets and trade like a champion to become a champion. Thank you very much for your attention. Thank you very much. So,